Hello, classmates. Our group report is about budgeting and responsibility accounting. My group mate, Sir Pedro, was able to discuss with you budgeting. Now it is my turn to share my understanding about responsibility accounting. So we have our learning objectives. And first, apply responsibility accounting to cost and profit centers. Two, explain the importance of evaluating performance. Three, demonstrate responsibility reporting system. So responsibility accounting. So like just budgeting, responsibility accounting is an important part of management accounting. Responsibility accounting involves accumulating and reporting costs that involve the manager who has the authority to make the day-to-day decisions about the cost items. All companies use responsibility accounting because, as you can see, without some form of responsibility accounting, there will be chaos in management's control function. So under responsibility accounting, a manager's performance is evaluated based on matters that are directly under the manager's control. Responsibility accounting can be used at every level of management where the following condition exists. First, costs and revenues can be directly associated with the specific level of management responsibility. Like, for example, Alexa, she is a division manager and she is responsible for controlling costs in her division. Another condition is the costs and revenues are controllable at the level of responsibility that they are associated with. Like, for example, Kevin here. He is the company president and he is responsible for controlling the company cost. Another condition is budget data can be developed for evaluating the manager's effectiveness in controlling the costs and revenues. Just like Rachel, she is the department manager and she is responsible for determining the costs in her department. So under responsibility accounting, any individual who has control and is accountable for a specified set of activities can be recognized as a responsibility center. Thus, responsibility accounting may extend from the lowest level of control to the top layers of management. So, when responsibility has been established, the effectiveness of an individual's performance is first measured and reported for the specified activity. It is then reported upward through the organization. So, responsibility accounting is especially valuable in a decentralized company. When we say decentralized, it means that the control of operations is given to many managers throughout the organization. And under responsibility accounting, segment reports are prepared periodically, such as monthly, quarterly, and annually, to evaluate a manager's performance. So the term segment is sometimes used to identify an area of responsibility in decentralized operations. And responsibility accounting is an essential part of any effective system of budgetary control. So the reporting of costs and revenues under responsibility accounting differs from budgeting in two ways. First, a distinction is made between controllable and non-controllable items. Performance reports either emphasize or include only the items that the individual manager can control. So, responsibility reports are budget reports that are scaled down to include only the items controllable by the particular manager. And responsibility accounting applies to both for profit and non for profit entities. For profit entities seeks to maximize net income and not for profit entities which to provide services as efficiently as possible. So controllable versus non-controllable revenues and costs. All costs and revenues can be controlled at some level of responsibility within a company. Under responsibility accounting, the critical issue is whether or not the cost or revenue can be controlled at the level of responsibility that it is associated with. So a cost is considered to be controllable at a particular level of managerial responsibility if the manager has the power to incur it in a specific period of time. So from the criterion, the following can be concluded. First, all costs are controllable by top management because of its broad range of authority. And next, fewer costs are controllable as one moves down to each lower level of managerial responsibility because the manager's authority decreases at each level. So in general, costs that a level of responsibility directly incurs can be controlled at the level. And in contrast, costs that are incurred indirectly and allocated to a responsibility level are considered to be non-controllable at that level. So the performance or the principles of performance evaluation. Evaluation is a systematic process of determining to what extent objectives has been achieved. And performance evaluation is at the center of responsibility accounting. Performance evaluation is a management function that compares actual results with budget goals. And performance evaluation uses both behavioral and reporting principles. Management by exception. This means that the top management review of budget report is focused either entirely or mostly on differences between actual results and planned objectives. This approach helps top management focus on problem areas. Management by exception does not mean that top management will investigate every differences. For this approach to be effective, there must be guidelines for identifying an exception. So the usual criteria are materiality and controllability. So when we say materiality, without quantitative guidelines, management would have to investigate every budget difference, no matter how small it was. Materiality is usually expressed as a percentage difference from the budget. So for example, management may set the percentage difference at a 5% for important items and 10% for other items. The company will investigate all differences that are over or under budget by at least the specified percentage. The company should investigate costs that are over budget to determine why they were not controlled. Likewise, it should investigate costs that are under budget to determine whether costs that are critical to profitability are being cut too much. So for example, if maintenance costs are budgeted at $80,000 but only $40,000 is spent, there could be major unexpected breakdowns in production facilities in the future. Another criteria is the controllability of the item. So exception guidelines are usually more for controllable items than for items that the manager cannot control. In fact, um, there are maybe no guidelines for non-controllable items. For example, a large unfavorable difference between the actual and budgeted property tax expense may not be flagged for investigation because the only possible cause is an unexpected increase in the tax rate or in the assessed value of the property. An investigation into the difference will be useless. The manager cannot control the cause. So the purpose of the management by exception is to only bother management with the most important variance from the planned direction or results of the business. Now we move on to the behavioral principles, a performance evaluation. So the human factor is critical in evaluating performance. So behavioral principles include the following. First, managers of responsibility centers should be directly involved in setting budget goals for their areas of responsibility. Without such involvement, managers may view the goals as unrealistic or arbitrarily set by top management. Such views can decrease the manager's motivation to meet the targeted objectives. Another one is the evaluation of performance should be based entirely on matters that can be controlled by the manager being evaluated. So criticisms of a manager for matters that he or she cannot control reduces the effectiveness of the evaluation process. So it leads to negative reactions by the manager and to doubt about the fairness of the company's evaluation policies. Number three, top management should support the evaluation process. As explained earlier, the evaluation process begins at the lowest level of responsibility and extends upward to the highest level of management. Managers quickly lose trust in the process when top management ignores, overrules, or bypasses established procedures for evaluating a manager's performance. Another behavioral principle is the evaluation process must allow managers to respond to their evaluations. Evaluation is not a one-way street. Managers should have the opportunity to defend their performance. Evaluation without feedback is impersonal and ineffective. So another one is the evaluation should identify both good and poor performance. Praise for good performance is a powerful motivating factor for a manager. Who doesn't want to be praised? This is especially true when a manager's compensation includes rewards for meeting budget goals. So note that we are emphasizing financial measures for performance. These days, companies are also trying to stress non-financial performance measures such as product quality, labor productivity, market growth, materials yield, manufacturing flexibility, and technological capability. Now we move on to another performance evaluation on reporting principles. Performance evaluation under responsibility accounting should be based on certain reporting principles. These principles relate mostly to the internal reports that provide the basis for evaluating performance. Performance reports should first contain only data that are controllable by the manager of the responsibility center, provide accurate and reliable budget data to measure performance, highlight significant differences between actual results and budget goals. Number four, be tailor-made for the intended evaluation. And number five, be prepared at reasonable intervals. So in responsibility reporting system, a report is prepared for each level of responsibility in the company's organization chart. So responsibility reports help to hold individual managers accountable for the costs and revenues under their control. So in a responsibility reporting system, a report is prepared for each level of responsibility in the company's organization chart. To illustrate such a system, we will use the partial organization chart in production departments of Pacheco Company shown in this illustration. So the responsibility reporting system begins with the lowest level of responsibility for controlling costs and moves upward to each higher level. So as you can see in this illustration, we have a report that comes from the lowest part of the responsibility people, which are the department managers. So these are the one that sees the summary of controllable costs in his or her department. Another one is the report from the plant operations manager that sees the summary of controllable costs in his and her operation. And we move on to the higher position, which is the vice president, that sees summary of controllable costs also in his and her functional area. And to the top management, which is the president, sees the summary of the vice president's report. Okay, so this is a reporting sample, a reporting from A to D. So we will be discussing one by one. Like, for example, the report D that is being reported by the lowest in the organization chart. Like, for example, the fabricating department manager. It is a typical of reports that go to managers at the lowest level of responsibility. And similar reports are prepared for the managers of the fabricating, assembling, and enabling departments. Another report from a plant manager Montreal, that is the a place where the plant is being located. So it is an example of report that are sent to plant managers. It shows the cost of the a plant that are controllable at the second level of responsibility. In addition, Report C shows summary data for each department that the plant manager controls. Similar reports are prepared for the other plants, like, for example, the Toronto, the Halifax plant managers. So that is for the report C. Now we move on to report B. It is a report at the third level of responsibility. It shows the controllable cost of the vice president of production and summary data on the three assembly plants that this officer is responsible for. So this is the report of a vice president production. And another report is a typical reports that go to the top level of responsibility, which is the president. This report shows the controllable costs and expenses of this position and summary data on the vice president who are accountable to the president. So this is the responsibility reporting system, which will begin with the lowest level of responsibility for controlling costs and moves upward to each higher level. So responsibility reporting system makes it possible to use management by exception at each level of responsibility. In addition, each higher level of responsibility can obtain the detailed report for each lower level responsibility. And this type of reporting system also makes it possible to do comparative evaluations. And comparative rankings provide future incentive for a manager to control costs. And responsibility reporting uh, are helpful tools for evaluating managerial performance. Too much emphasis on profits or investment, however, can be harmful because it ignores other important performance issues such as quality and social responsibility. Now we move on to the types of responsibility centers. We have three: the cost centers, profit centers, and investment centers. These centers indicate the degree of responsibility the manager has for the performance of the center. When we talk about the cost centers, it is more of the expenses, but does not directly generate revenues. So managers of cost centers have the authority to incur costs. They are evaluated on their ability to control costs. So cost centers are usually either production departments or service departments. The centers provide only support services. So for example, a motor company for automobile plant. The welding, the painting, and assembling departments are production departments. The maintenance, the cafeteria, and human resource departments are service departments. All of them are cost centers. So another one is profit centers. These incur costs and expenses and also generates revenue. Managers of profit centers are judged on the profitability of their centers. Examples of profit centers include the individual departments of a retail store, such as clothing, furniture, and automotive products, and branch offices of banks. So, like a profit center, an investment center incurs costs and expenses and generates revenue. In addition, an investment center has control over the investment funds that are available for use. So managers of investment centers are evaluated on both the profitability of the center and the rate of return earned on the funds invested. So investment centers are often associated with product lines and subsidiary companies. So the scope of investment center managers' responsibility significantly affects the content of the performance report. So now we move on to the review of the learning objectives. The first, responsibility accounting, involves accumulating and reporting revenues and costs that involve the individual manager who has the authority to make the day-to-day decisions about the cost items. And the evaluation of a manager's performance is based on the matters that are directly under the manager's control. And the primary basis for evaluating performance is the return on investment. And the responsibility reporting system begins with the lowest level of responsibility for controlling costs and moves upward to each higher level. Okay, so thank you for listening and God bless us all. Goodbye.